Okay, good morning, ladies and gentlemen, and welcome to MACROACE with your host, Tony. I'm also the head financial analyst at FinancialJuice. So let's get right into it. Good morning to you all. With the US CPI data, quite a bit to cover actually this time around with the sentiment and what Fed speakers have been saying. Of course, you've had that period over the holiday where nobody really said anything until the 3rd of Jan. Is when we had the first comment from a Fed member. But first of all, let's go through what the inflation print is all about. So it measures how much consumers are paying for retail goods and services. And the way it's measured is you have 26,000 retail outlets, 4,000 housing units in 87 urban areas, where prices are collected on 80,000 different goods and services. So the key measurements, what makes up the CPI report is housing, about 42%, food and beverages, about 14%, transportation, 18%, and medical care, about 8.5%. And of course, you have the core data, which excludes food and energy, which is seen as a better gauge of actual inflation. But then, of course, you do have CPI, you do have PC price index, which is the Fed's preferred measure of inflation, because that has measures inflation across the USA and places less of a weight on energy as well. And then in regards to the monthly figure, the seasonally adjusted, which is the more preferred data, because that shows what's going on within the economy without the effects of weather, production cycles, and so on. Okay, so the difference between PC, as already mentioned, you have PC, which focuses on the US as a whole, CPI focusing just on urban areas. As so, PC places a low weight on prices of gasoline and of residential rents. And as I said, rather than just focusing on urban areas, it focuses on everywhere. Now, how does it affect the markets? So with a stronger than expected CPI print, you'd expect the dollar to see some upward momentum or bullish reaction in anticipation of higher, in anticipation that rates will stay at a higher rate for longer, or that the bets of rate cut for this year would be extended, i.e., I mean the timing of when the first rate cut could happen, or the amount of rate cuts that are expected by the Federal Reserve could then decrease if inflation is hotter than expected. For the stock market, still at the moment, inflation causes a bearish reaction if the data is much stronger than expected overall. Particularly the core data, that can, if you do see a sharp rise within a month or for the year-on-year for the year-on-year data, that can lead stocks taking a hit, and also repricing their expectations for the Federal Reserve and how many rate cuts are expected for this year. And then for the bond market, similar to the dollar, if bond yields, if inflation does come in lower than expected, bond yields will tend to go lower in anticipation that the Federal Reserve is more likely to ease in the future on a much sooner rather than later. And on the flip side, bond prices will then in turn go higher in that effect. The other reasons why the other effect that bond yields can have from lower than expected inflation is that if the economy is going from contraction to expansion, usually if you do see inflation data lower than what the Federal Reserve's target is of 2%, or there is disinflation within the economy, and businesses want to see their prices go higher, so of course they get more money, then low inflation prints can mean that bond yields again will go lower because the economy is not expanding that much, or is becoming weaker in regards to prices within the economy. So those are the two reasons as to why bond yields can go lower off a lower inflation print, and then vice versa for if inflation was much higher or much hotter than expected. So the previous report then in December, representing the November report, So looking at the monthly index, so the index for shelter continued to rise in November, offsetting a decline in gasoline. Then the indexes which increased in November include rent, owner's equivalent rent, medical care, motor vehicle insurance, and those that had seen a decrease was in household furnishing and operations, communication, and recreation were among those that decreased over the month. And where is the economy at the moment? So we had the non-farm payrolls last week, and that came in at 216k, which was hotter than expected compared to the prior 173k. The unemployment rate remained unchanged. Average earnings ticked up to 4.1% compared to 4%. Employment costs for the quarter, for the last quarter, were at 1.1% compared to 1%. PC price index year on year ticked lower to 2.6% compared to 2.9. The core PC price index year on year was at 3.2 compared to 3.4. ISM manufacturing prices paid was at 45.2 compared to 49.9. Services prices paid was at ticked lower as well to 57.4 compared to 58.3. Productivity had seen an increase to 5.2%. Import prices had also seen an increase for the month, whereas export prices as well. And then PPI, which is coming out tomorrow, but looking at the last report, did see a decline to 0.9% for the year-on-year figure, and also for the core year-on-year figure as well. So overall, it presents the reason why we look at where the economy is at overall is because we want to see how could the economy overall have an impact on inflation data. And these economic releases usually will have an impact on, all releases will have an impact on inflation data. But these releases in particular focusing particularly on the jobs market. If there are more jobs that are added to the economy, then there is a higher likelihood or higher chance of people taking on those jobs and then increasing their spending. And then if you look at what manufacturers are paying to make their goods and the services side for providing those services to other businesses, then we have to take that into account too of the price pressures. Although inflation is headed towards the Fed's 2% goal, it's still important to understand how much of a deceleration or acceleration are we expecting for the inflation print, or a rough kind of gauge of where inflation is in the economy so far. And overall, with the PC price index data, you are seeing that gradual decline in that data there, and the prices that manufacturers and service providers are taking on are also seeing a bit of a decline as well. But it depends on how much of a decline we get today, as the year-on-year is expected to tick up to 3.2% compared to the prior of 3.1%, as is the month-on-month data as well, which is the two headline figures, excluding the core data reads. So let's carry on then. The triggers then for the economic release, what are economists looking at? So for month-on-month, they see a high estimate of 0.4% with a low of 0.1%. The year-on-year with a high estimate of 3.6% and a low of 3.1%. The core month-to-month with a high of 0.4% and a low of 0.1%. Now, CPI data in general from history as well has always caused some sort of a market reaction. Whether there be a 0.1% deviation on the figures, or if the figures will come in as expected, it's because everyone is so focused on inflation, how that affects the Fed's outlook for their monetary policy, that it still garners attention, and you can't really put it aside. Although, as said, inflation is headed towards the central bank's target of 2%. So, if we're looking at the other areas too, as said, core year-on-year with a high estimate of 4% and a low estimate of 3.7%. So the sentiment and views then of the different investment banks and what they see. So Morgan Stanley's Gorman on the 3rd of January said that the economy is fine and a recession is unlikely, and the Fed has done a good job. Goldman Sachs, they said on the 10th of January that they expect the Fed to start tapering its balance sheet runoff in May, citing cautious recent comments from Fed's Logan from Dallas. And they see the Fed halving the monthly pace of runoff of Treasury securities to $30 billion in May from its $60 billion cap. So that's going to be, if we're thinking about sentiment shift and what becomes important and what the Fed will then focus on, with these comments that are coming through about the amount of tapering that the Federal Reserve does and how much they have on their balance sheet, which is around $7.6 trillion at the moment, down by about $1 trillion or $1.2 trillion. That then becomes the next point: is how much tapering does the Federal Reserve do? Because if they reduce the amount of tapering that they do, means that they're reducing their balance sheet, but they're still wanting to support the economy and make sure that they don't over tighten to the point where the economy goes into recession. Or do they continue with their pace of reducing their balance sheet by $60 billion in the for the Treasury securities area? And could that then lead to tighter financial conditions that maybe banks would be expecting or looking for? JP Morgan, they said that the Fed may end up cutting interest rates more than it's currently signaling as the US economy slows, driving a rally in shorter maturity treasuries. Markets currently looking at 1.5% of cuts, which is hovering between 1.5 or 1.4% and 1.5 for this year. Now, the median projection is for 75 basis points of is for 75 basis points of cuts by the year end. So the reason why I'm linking the balance sheet comments to the CPI data is because if you do see hotter than expected inflation within this report here, that could then keep the Federal Reserve on the path of their current balance sheet runoff rather than trying to reduce it and support the economy. Because if they continue to support the economy, then that will then lead to hotter inflation overall. If the economy is if US debt is being bought by the Federal Reserve. So what they want to try and do is have an equilibrium where they're not tapering by too much, but they're also not continuing to support, or they're not supporting the economy to the point where inflation expectations start to creep higher, and internally inflation then goes higher from more spending that is then done within the economy. So there are what I'm saying is there are different factors that we have to take into consideration. Although it is just one report for CPI, there are other reports we have to look at to understand what the Federal Reserve's position could be for their quantitative tightening phase, and how much they taper their holdings by. But this is just one of the things that we need to be aware of what could affect sentiment in the future. Okay, also then looking at CPI forecast for the year on year. So you have Morgan Stanley saying 3.9%, Bank of America 4%, Goldman Sachs 3.9%, and JP Morgan 3.7%. Don't forget, if you like the video so far, then give it a like, share the video, subscribe to the channel, and get the word out there. All right, so going back to this here. So with Fed and government views, more or less just Fed views here, rather than any government views. So Fed's Powell on December 13th said that policymakers are thinking and talking about when it will be appropriate to cut rates. Fed's Bostic says that he sees an initial rate cut in the third quarter, and he sees 2 quarter-point rate cuts as being appropriate by the end of the year. Fed's Bowman says that we are not yet at the point where rate cuts are appropriate, and policy appears sufficiently restrictive to hit the 2% goal. Fed's Williams on the 10th of January says that he sees inflation ebbing to 2.25% this year and 2% in 2025. One of the other key comments that he made, being a board member on the Fed from New York, is that he said the monetary policy is now tight enough to guide inflation back to the Fed's target. But he did suggest that policymakers need more evidence of calling inflation before cutting interest rates. So he was seesawing or on the fence about when the Fed should cut rates and what that would look like. So he left it very open to markets in their interpretation of what Fed's Williams had said in regards to inflation. Then the other key comment to be aware of is you had Fed's Logan, and again talking about tapering. So Fed's Logan said on January 6th that the Fed may need to slow the pace at which the central bank is shrinking its asset portfolio as balances at overnight reverse repurchase facilities start to dwindle as well. So again, linking back to what Goldman Sachs were talking about, the expectation of the Federal Reserve potentially decreasing by the amount that they cut or taper their assets. Okay, so market pricing then, if we look at that, so December 12th, they had post the CPI data. Fed swaps priced in slightly higher odds of 2024 rate cuts. US short-term interest rate futures paired earlier gains, and traders are now betting on May 2024 for the first Fed rate cut versus the earlier bet of March. And then December 13th, Fed swaps price policy rate under 4% by December 2024. 14th, Fed swaps price in more than 140 basis points of rate cuts by the end of 2024. And then on January the 5th, Fed swaps repriced the odds to 70% chance of a 25 basis point March Fed rate cut. Okay, and then this was the last market reaction that we had seen. So when the data initially had come out, if we're looking at how the markets had reacted, so you had seen the month figure had seen the only increase in inflation. Okay, whereas everything else came in as expected. But if you're looking at the year-on-year, it was lower than the prior figure. The core remained unchanged, and the core CPI month-to-month had seen the only increase compared to the prior here. So this was the initial market reaction of the data. He'd seen strengthening from the dollar yen. So on the first candle, there was whipsawing that had occurred. And I said strengthening from the dollar, weakness from the S&P, and also weakness from gold as well. Then if I go to the next slide, and again, as said, so this is, again, as said, on the same candle, on a 1 minute chart, you can see that there was a quick reversal off of that initial move. So the deviation wasn't that strong. It wasn't that big. Hence, you had seen this sort of market reaction where the markets were confused about which direction they should go, because the data didn't really provide a clear path as to what inflation would be like in the future and how the Federal Reserve would react to it. So the bets and the speculation is what caused this market move. So ideally, what you'd want is, if we just get out of this here, So ideally, what you'd want, if we're looking at the ranges and deviations, is you'd want a clean slate with the direction that the data goes in. And I mean by either it's much hotter than expected or much cooler than expected across the board to see enough of a strong reaction. We have seen where in the past, where two bits of data would have seen a reaction that sustains itself over the first initial reaction. So this little bit here that I've just highlighted, the first number on October the 12th, where you'd seen an initial 39 tick move towards the downside. After about 10 minutes of trading, it was down by 58 ticks. And then after about 30 minutes of trading in the blue brackets here, going to the end of the candle, it was down by 59 ticks. So here's an example of where the data was going in one direction, but the reaction was choppy, and only post-market did the reaction start to kind of solidify and see a strong sustained move towards the upside here. So you'd seen on the first candle, there was an initial 39 tick move towards the downside and 147 ticks towards the upside. Again, the deviations weren't as strong as what the markets or was as what economists might be expecting. Hence, he had seen that mixed reaction. So ideally, I said you'd want a bigger deviation, or at least a 0.2% deviation on all of the figures to get a decent reaction out of the market. Considering how the last reactions have played out, when you have had a movement, when you have had all the figures either going higher or lower across the board. So that's ideally what we want to be looking for, at least a 0.2% on all the figures for a strong, decent reaction. Now that doesn't mean you can't jump in if you do see a couple of the figures that go in one direction and capture that momentum and jump in for a short trade. But then there's more risk because it's not as clear. It's not as defined, but that's totally up to you. Whatever you want to do, whatever works for you. Jumping in and out, or either waiting for a bigger deviation and then going in. If there is mixed data, then that could also hinder what the markets could be thinking. And it might make it more difficult to decide which way to trade because the markets will also be trying to figure out which way should they go. Like last time around, when there weren't any deviations, but some of the figures were higher than the prior figures or lower than the prior figures, it made it more difficult to determine which way. But if we're looking at what's seen the most market, or what's seen the strongest market reaction overall in terms of strength, pip-wise, generally it's always been the dollar yen that has seen the biggest market reaction in the currency space out of everyone else. And then if we're looking at other places too, so you have cable, which is kind of between second and third place with the euro dollar as well as being the next, which was the next largest market reaction in the currency space. If we're looking at the bond space, bonds, the 2-year treasury had seen the biggest market reaction. That's of course the closest to the short end of the yield curve, and that is the most sensitive to interest rate decisions as well, and also speculation. So that had seen the biggest market reaction there. So the dollar yen, cable, and the euro dollar, and the 2-year bond price, 2-year bonds see the most market reaction in regards to the data. Okay, so we've got about 5 minutes left now. If you're looking at this sheet here and you're wondering, what the heck is this? What am I looking at? So this shows you how big the market reaction is was to different economic releases that we cover or have covered in the past. So this little box here. So actually, if I go here, this shows you the deviation, comparing the actual figure to the forecast. How big was the deviation there? And then this shows you the market reaction. So it said, let's go start with an easy one. So going back to October. So this represents the initial market reaction, the number that I've highlighted here, going to the wick of the candle to capture the entire move. And then the figure in the black brackets shows you the movement 10 minutes after the release has come out, going to the end of the candle. Okay. And then the blue bracket, or the figure in the blue brackets shows you the market reaction, again, going to the end of the candle 30 minutes after the economic release has occurred. Now, if you see here, and you've got it here in the box above, where it shows you if there's been a reversal or if there hasn't been a reversal. So if you see here as an example where you'd seen an initial 39 tick move towards the downside, if after 10 minutes it's going in the same direction, you won't see another word. You won't see a word in there. So if you did see 39 ticks down, but then after 10 minutes of trading it reversed that and went up 58 ticks, then you would see 58 up like that. Okay, but in this case it was staying in the same direction and actually headed lower as well. Does that make sense to everyone? Hopefully that makes sense. Have been meaning to make a little article about what to do. Hey, this is an interesting headline. CNBC interview: Kathy Woods sees a price of Bitcoin reaching $1.5 million by 2030 under bull case. I wish. Anyway, getting back to the news. So yeah, so if you want access to this, then all you got to do is sign up to the MACROACE mailing list, and you get access to the Google Sheet here. This is live in a real time. Okay, they get to see me do the updates on the sheet here. Also, on top of that, you get an email on a Monday, which will, as I said, provide you the link to the Google Sheets, and you'll get a short summary of what to expect for the week ahead in US, Europe, and Asia. Very short summary, maybe a couple of paragraphs here or there. It's not a lot. It should be used as a refresher and a little, let's say, a bullet point checklist of what to expect for the week ahead. In that as well, you can also get the upcoming live stream links as well for the streams that we would cover for that week. And that's sent on a Monday. I know this week it was sent on Tuesday because of my health. Came down with the coffee flu, and that was not nice. You're probably still hearing my voice at the moment. Hopefully you guys don't. If I breathed, I sound like an old guy. And that's losing his breath. Or I sound like I smoked 40 a day, which isn't a nice sound. Anyway, so we've got a minute left. Let's get to the release. Let's get ourselves set up. So we're looking at the dollar yen top left, S&P bottom left, and gold here in the top right. Let's get our TICKSTRIKE setup ready, and then we'll see if we do get 0.2 deviation on these figures. If we don't, then it's probably going to be a quick in and out trade if you can get into it quick enough, but that's not really possible all the time. Let's put that here. Okay, 10 seconds. Okay. So 3.4% for the year on year. a 0.2% deviation compared to the forecast of 3.2%. Okay. So strength on the dollar, weakness in the stock indexes. Month to month, seen a 0.1% deviation. Okay, at 0.3%. Core, 3.9%. Okay, let's let this thing. Okay. So data was stronger than expected overall, with a 0.2% deviation on the year-on-year. Month-to-month came in as expected and also unchanged from the prior as well. Okay. Okay. Right. So currently got that going on at the moment. Let's see how that plays. And just touching it. Okay. Right. Let's get out of that. And done. Okay. Nice. So still seeing some of that selling momentum on TICKSTRIKE there off the back of that data. So 0.2. So I said a 0.2% deviation on the year on year. Everything else has seen a 0.1% deviation. The initial market reaction then, let's have a little look on the S&P. So jumped in and jumped out on the NQ. So 75 ticks or 77 ticks towards the downside on the S&P NQ. Let's see, what do we do? Let's see, what do we get here? Okay. It's about, wow, okay. 382 ticks towards the downside on the NQ. What are bonds doing? Here we go. Yeah, there we go. There's the 2-year bond. Okay, 36 and 36 down on the ticks down on the initial market reaction. Let's have a look at Bitcoin too. Let me get this up. Well, Bitcoin be Bitcoining. There we are. It's about 30 ticks. Okay. All right. So didn't get a 0.2% deviation across the board. Got it on the year on year. Jumped in with the momentum. And of course, the data was more or less higher than expected. Also compared to the prior figures too, for the year on year, month on month, lower than the core year on year, but still higher than what the forecast was. And the month on month remaining unchanged. So that more or less concludes the live stream for MACROACE. Just some other things to go through. Remember, if you enjoyed the live stream and you found it useful, don't forget to give the video a like, share the video, subscribe to the channel, get the word out there. And also, one more thing to go through. So with FinancialJuice, so you can see here, FinancialJuice is a live voice and text service. So if you've never come across a live voice and text service before, well, what it does is it provides you with up-to-date news of what's going on within the markets globally as well. Okay, just looking at some of the, and also what are markets doing? How are they feeling? As you can see here, with Fed swaps pricing less monetary easing in 2024 after the hotter than expected inflation. Traders of futures contracts tied to Fed policy rate reduced bets on March rate cut after inflation data. Let's bring up the CME. I don't know if the CME Fed Watch is going to bring up anything new today, or if it's going to update. Let's go to March. No. Okay. All right. But yeah, so as said, a live voice and text service, keeping you up to date with what's going on within the markets globally. If there's a Fed speaker or central bank speaker that's rocking the markets or saying something, then this is the place to keep to look out for. So you have your live voice feed here, okay, which is where I've just clicked the button, okay, right there. On the left-hand side, you have your economic calendar as well of the upcoming economic releases for the week. And in the center, you have your news feed here of the headlines and economic releases as well. So everything is all in one place. And then finally, the need to know market risk, i.e. what risk should traders be aware of for the trading session ahead, and what's already happened that has led to the markets seeing a reaction or changing their sentiment. Okay, that's all in one place, and you can have a trial of that for 7 days. Okay, you can go here. Actually, let me explain a bit better. So the link that I've just provided you goes to the light version of FinancialJuice, which is the free version. Okay, that's delayed, has adverts playing, and you have adverts banners that do appear. But if it's the first time you've ever come across a live voice and text service, then using the live version, albeit delayed, will give you an idea as to how a live voice and text service could be used within your own trading strategy. If that's something that you want to incorporate or trying to incorporate, but haven't really had that opportunity to do so. So have a play with the live version. Now, if you want to go straight to the pro version, where there are no delays to the service, it's all in live and real time. Then in the top left-hand corner, where you can see the logo saying FinancialJuice Pro, on the live version, it will say Go Pro. If you click on that, then you can subscribe to one of the subscriptions for FinancialJuice Live. But make sure, if you do go straight for the pro version, you have an account set up with your login deeds on FinancialJuice Lite before you go pro. Otherwise, if you pay for it straight away without having an account, then it becomes a bit of a mess. So make sure you have an account first on the live version of FinancialJuice, and then when you're ready and comfortable, then go ahead and select your subscription for the data for the pro version of FinancialJuice. I got some questions. White Eagle. What question did you have? Hold on. Huh? What was your question? Why long gold when is bullish? Huh? Are you talking about the initial market reaction? are you talking about this little bit here, or this wick, the initial wick? The report's not. If you're saying, when you're saying bullish, you got to be careful when what you're referring to. If you're referring to the dollar, it's obviously bullish for the dollar, but for stocks and bonds, stocks and bond prices, it's not. And for gold, it's not bullish, because the dollar is seeing strength, and there are bets that have decreased of the Federal Reserve, the amount that the Federal Reserve could cut by. Actually, let me just get that up again. Yeah, so Fed swaps pricing in less monetary easing in 2024 after the CPI. Sometimes what happens, just like with any sort of trading, there'll be traders that will have their trade ready and set up to go before the economic release has even come out. So you can get that initial whipsaw from the markets that could surprise traders and go, ha ha, slap in the face. If that's what you're referring to, I think that's the only thing that I can see if you're referring to the initial move on gold. Anything else, I don't have a clue. Crazy to Eccentric said, thanks Tony. Last night Kathy tried to get Elon to work with people on an X chat, creating a use case for Bitcoin on Mars. Okay. Okay. What else do we have here? I'm just going through some of the comments now because I have not seen these comments. Do you guys find this live stream useful? Yay or nay? Was it good? Was it all good in the hood, or was it just rubbish? Or was it not that great? If you have seen the previous live streams, was it as good as the previous ones? Could there be some improvements? So it's always good to get some feedback from you guys as to what's worked, what's not worked. If you're new to the channel, if this is the first video or live stream that you're seeing, is there anything that you found interesting or different? Let me know. Let's see. Can I give feedback in private? Nicholas D'Souza says, we know you made money. Yeah, the repo markets are quite interesting. We're talking about QT. Yeah, message me in private. Yeah, you can send me an email. Tony at FinancialJuice. There we go. You can send me your thoughts and your reviews. Yes, QT is always an interesting one, because usually what happens is that the Federal Reserve, what's happened in the past is the Federal Reserve starts peeling off the amount of treasuries that they've bought during that period that they have during the initial easing periods, and then they go back to where they were beforehand. This time it's a little bit more sensitive because of how quickly rates have been raised and the condition of the economy. The job market is still resilient. That's shown through the figures, the figures that we had seen from non-farm payrolls. Consumer spending is still okay, and inflation is headed towards the 2%. Whoa. Let's say it was. I was about to say is, but it was headed towards the 2% goal. Now this one kind of throws it off a little bit. So with quantitative tightening, that, remember, is the Federal Reserve letting the bonds that they've bought roll off, i.e. just go towards maturity. So not doing anything by cutting them off or selling those bonds off early. They're just letting them fill out their term. Okay. Now, if the Federal Reserve were to reduce the amount that they taper by, that means that they're looking to continue bringing down their balance sheet, but by not as much, in case that they fear that it could have an even stronger tightening effect on the economy. Remember, they're buying US debt, and that's about 7 points, and they've bought about 7.5, or they have about $7 trillion or $7.5 trillion of that debt on their books. Okay, and that's gradually going down by $60 billion, $60 billion a month. So if they were to ease off on that, then okay, it puts more reliance on the US economy itself to do the heavy lifting and keep the economy going, rather than the Federal Reserve. So if I'm your daddy and I say, hey, here's $50 a pound for the week, but next week you're gonna get next week, and then in 2 months' time I'm gonna start cutting back, and then you're like, okay, maybe you're gonna come back by $20, okay, and then in the future I say, okay, like I know I've cut down by $20, I might just cut back by $40 from now on. So you're still, getting less of an allowance, so you're relying more on yourself, but I'm slowly cutting back. Okay, kiddo? Does that help? Hopefully that helps. All in all, the less support you provide for the economy, the more reliance there is on the economy itself, and the more risk or the higher chance that there is for the economy to then head towards a recession. I'm not saying that it's going to be an automatic thing, that you taper off bonds by a bigger or smaller amount, but there's a high likelihood if you increase the amount of tapering, or if there's less support provided to the economy, then there's a high chance of that. So in this case, the Federal Reserve is trying to keep an equilibrium between tapering the treasuries that they have within the economy, that they've bought within the economy, whilst also not trying to let the economy then falter. All right, so provide the link for FinancialJuice TICKSTRIKE. So if you're unfamiliar with TICKSTRIKE, what it does, it allows you to measure how strong the buying or selling momentum is, or in other words, how strong is the buying selling momentum in stocks, forex, crypto, ETFs and ETNs, your internals like your VIX or your ADD, and you can use that in a particularly, if you're a day trader, if you're a scalper of the markets, you can use that as a tool, and that'll be one of the tools that you can use to capture, to understand how strong the buying or selling momentum is within the markets. So let me bring up this little box here. Let's go with the S&P. Okay, this ticker box here shows you the buying or selling momentum, and it gives you a visual and audio alert of that. Now the number represents the strength of the sensitivity of the ticker box. Okay, 1 is the most sensitive to market reactions. So when there's a little bit of buying or selling that occurs, then TICKSTRIKE will give you a visual and audio alert to that. Or you can decide to whether to go visual, audio, whatever you want. Okay. And if you were to increase that level all the way to 15, 15 is the least sensitive to market reactions. So only when there's a big amount of buying or selling momentum within that within the asset that you're looking at, only then will TICKSTRIKE give you a visual and audio alert. And as I said, as a day trader, you can use this to what we've seen in the past. What traders have said is that they manage their risk, capitalize on potential trades. And you can use it however you want to use it, whatever works for you, to see it or to utilize it. Particularly if you're a scalper, then we have this lightning symbol, which is uber sensitive to market reactions. So one is the most sensitive, and it'll give you an alert more or less all the time. The lightning symbol goes 15 levels below 1. So you're going to minus 15. Okay. So every little bit of buying or selling momentum that you see, you can kind of see it in action now. TICKSTRIKE will, or the lightning version of TICKSTRIKE will give you that indication there of the buying and selling momentum. Of course, you can chop and change whatever level works for you. It's a bit crazy for me, but I prefer keeping it off. But as I said, if you're scalping the markets, and again, it's a perfect tool for you to have to utilize and use and see. And again, if you're unsure of how it works or you want to have a play around with it, then on the site here, we have the free version, but that's restricted to the four different assets. As you can see here, the S&P, Eurodollar, oil, and Bitcoin. Okay, and the strength is also limited to or the sensitivity, I think, is to 6, so around halfway. But if you never used TICKSTRIKE before and you want to have a little play around with it, have a little play with it on our feed here on the site. See if it works for you. If it doesn't, then of course, then you would know. But if you want to have a look, if you want to have a play with the full version, okay, of TICKSTRIKE, you can get a 7-day free trial for 7 days through that link there. Okay, and then you can have a little play with it and see what works for you. Okay. All right, so that more or less concludes the stream. Thank you very much for joining me live. I'm not on Instagram, no. But the information is lagging. QE. Yeah, QE is risk on quantitative easing. We've seen in the pandemic when the Federal Reserve started buying up the bonds. Okay, when the markets weren't convinced that, of course, rate cuts were not going to do enough to save the economy, when the Fed started pumping money into the economy and buying the US debt, then you'd start to see a real run of risk on. And of course, you have the government to help the economy too at the same time. And then, yeah, QT or quantitative tightening is the opposite of when that occurs. Of the economy being supported. Okay, thank you very much. I will see you guys next week. That concludes MACROACE. That email I'll send out to you guys Monday morning. One email, and for anyone who's just subscribed to the main list, you'll get the ranges and deviations that day in that email on a little button that just says ranges and deviations. All right. Thank you very much, guys. Have a great rest of day, and I'll see you guys next time.